Hello and welcome, and it is the first day of March 2018. My name is Derek. Everything you do is within your own risk, own reward. If I happen to be a day trader for the markets, this is where I probably look to buy one of those 2x, 3x ETFs related to the Dow Jones, or maybe the S&P or something similar. Of course, the last time I would have done it in here, I guess I wouldn't have done it because it came down and lifted off. It's when you reach support, a key level for the first time. But I might have bought in here, and I sure as heck am looking for a bigger move to sell. This wasn't much of a rally. Although you can see in this breaking down point in here, just mathematical strategy. That if you're playing the market, you see this key line, you're like, okay, let's buy here. And at first you're like, man, what a genius. Higher highs, higher lows. If you're able to profit, then how do you do? Well, day trading, when you do something like this, one thing that can work out well is calculate the Fibonacci from this level to this level. And you're going to get two key numbers, the 61 and the 38. So the second one below. When you see the market failing within such, and that level would have been somewhere around the support mark. And when you've seen this move in here, it's not a surprise that you had the decline as such. And when you don't find support or much support at a key level, then you oftentimes will have decent legs lower. Now, as far as this volume is concerned, just ignore it. I know it's in the way. It's just, I could probably hide the volume. Let me see if I can. Okay, so now, within this situation, okay, we'll see how well this thing can close. Maybe as a trader, I'd be looking to see the last couple hours have a little bit of a rally, maybe get me a few hundred points, a couple hundred points on the Dow. We'll see. Let's take a look at this on multiple time frames. This is the 5 minutes. So let's just go 30 and just see what comes up. And yeah, there we have it. This is long-term major Fibonacci levels that I've calculated a while back. Well, a while back is in many days. So as we can see, we had lame-ass support here, which came up to the 18 average of highs on the 30-minute time frame, and then when it broke through, fast moved down, had some consolidation within the 18. We can see as it left it, fast moved down to this key support level with what is a pierce below at this stage. And if this doesn't find support, fast move to the next one. But I've already looked at the daily time frame, and it does not look good. We'll move our way towards it. We'll go like the 2 hour or the we'll go the 1 hour time frame. 2 hours, 2 hours. So then we can see in here that this number would be close to the 38.2% Fibonacci level from here to here. And maybe that's why I drew it in for such as those levels. Actually, I probably did do that because that's exactly what this looks like, is a 61 and 38. So here's the situation when it came up to a level where it was supposed to be resistance, and it was. So bullishly and bearishly, it was supposed to not go up anymore. So then you had your correctionary move. This is the battle between the bulls and the bears. It looked at first here as if the bears were going to win or proceed to their turn with the dice, as it's either the bulls or bears having their turn, but that didn't happen. The play stayed neutral, and you can see on the breakout here that the bulls took control, broke above this resistance. And when you have a move, does it have a decent leg higher, not too large, not too small? Yes, check mark. Did it find support where it came from? No, well, that's okay, I guess. I mean, as long as you make a higher low or matching low from there, well, it didn't do either. So you have the pattern of higher highs and higher lows, and a higher high has been followed by a significant higher low at this point. Within the 2H time frame, there is not a single green candle of okay proportions. There's 1, 2, 3, 4, like 6 or so decent red candle proportion moves within this level. So now it's bullish and bearish to have a rally. It is bearish to come up, meet up with this 18 average, even up towards this previous resistance here, which would be a lower high. Or even just go sideways for a few periods. Maybe Friday just hover around this level, then Monday it falls through. And it's bullish, of course, to go up. That's just obvious. That should go without saying. So we'll see how this level acts as a level of support. But like I stated on the daily, it does not look good. So when you notice the volatility of these size of these candles, that's normal in the bull market to have a little move volatility. And it's normal when you have these down moves to have them with larger moves, both for up and the down. So therefore, when the market can either stop going down and return a bull market, and the 18 average will indicate us to do so, it hasn't yet. And then you'll start to notice the volatility will start to shrink lower and lower each day, each week. Or if this thing goes on a major down move, which will do so with decent sized volatility all the way through, then when it can at least start to go sideways and consolidate that way, that's when you'll have the lower volatile moves as well. But as far as the market action is concerned, it made a major statement as the 18 average got destroyed with a big major extension below the 18 to a degree where its first decent rally from a low on February the 7th almost came to the 18 average of highs. This was 25,000 and change after it came from 23,000 and change. So that was almost 10%, and it didn't even make it to the 18 highs. Then it had a little bit bigger of a down move, just barely making a lower low rather, and it had a tremendous up move up to the 18 average of highs, back down and band flattening out, able to get above the resistance, but it's showing me that this breakout that occurred on the 26th of February is looking to be that of a possible failed one. And what do we know about failed moves? That oftentimes fast moves coming through. So we've seen this big down day today. That means as we move into the next session and following through, that this is definitely in a, it's definitely, what's the word I'm looking for? It's more apt to higher probability odds for such an event of even further decline that would at least match this level. But we could be talking about, oh, what's the Fibonacci downside from here to here? And I can give you that answer really quickly. And it's 21,960-ish as a potential down move. That would be a loss of, at this stage, of about 5,000 points. And that would be about 20%. So there's definitely major concern now in this market just based on the actions that have been occurring during this correctionary move. Let's move on to the 3-day chart. Now this line at 23,000 is the Fibonacci upside level from the 2007 highs and the 2009 lows. So when it came to it, it blasted through it, and it had a decent sized move going forward. On the weekly chart, we could just see more of the bull market. So we'll just switch this over to the monthly. And this is the Fibonacci downside point, but I guess we'll need to see the quarterly. And when we look at it from this point of view, and I know it's going to be difficult to see with the lines, but it's actually, everything's all standard. We have a beautiful up run in a market like this, which corrects through time with some solid up and down moves along the way. So the 2008 crisis was a very solid down move within a sideways market. And then it's broken through. A lot of people are saying it's the Fed and just propping the market up by adding liquidity. Maybe that's true, but either way, when we look at the upside level in here, it's not uncommon that if this is a major top and price action does come down to at least back to previous high of 2007 in the 13,000 area, even up to about, even down to 11.7 up to 14 or 13.9. Well, 14,200 is a high. That would be where it came from within this long-term time frame. And if it did top now and you start to see a few red candles, you then have an 18 average test, and it's going to either go sideways, break through, make a lower high, any of that type of stuff. But if there's a significant move there, you'll look at this number and say, well, the upside worked. It pierced extra just by a bit, because if it was supposed to go to 23 and it went up to 26 change, it only went like 15% higher after it had a move of better than 3x from its low. So that's close enough. And that will now conclude this, this video. I do not trade this market. I'm just going over the technical analysis as I see it. Of course, what you do is always within your own risk and your own reward. Take care. Bye-bye.